Ladies and gentlemen, welcome back to the channel. We're going to get into everything happening here on the day with AMC as well as the broad markets, specifically a new note put out from Morgan Stanley today that doesn't sound too good for our markets, guys. So we have a lot to cover in a very short amount of time. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So first and foremost, AMC stock down today. Down about 6.5%. The markets themselves don't look very good today. Some individual stocks doing well. Markets as a whole, S&P down close to 0.5%. The Russell down closer to 1% today. So not a hugely positive day nonetheless. So it's no coincidence that AMC is down. AMC, we're heading into a big catalyst at the end of the month. You're in this narrative, and I will say this again, you are in this narrative of sell the rumor, buy the news, where AMC stock has been falling precipitously. Really hasn't done anything in over 3 months. And that likely ends at the end of this month. But leading into that catalyst, the stock likely falls, as you have seen really as of recently, as of about May 5th, the stock peaked out about $6 per share, currently sits at $4.50 per share. It has not participated in this rally that we have seen. Like, none at all. Okay. And that likely turns into a rally after June 29th, after the next court date. But from now until then, expect some downside, okay? Now, tomorrow is going to be a big catalyst with Fed Jerome Powell. Fed Jerome Powell has the opportunity to crash the markets if he wants to. If he was not hawkish enough, he's going to Paul Volcker the markets, metaphorically speaking, talk down this market, and cause stocks to fall. He has that power to do so, although not a lot of people give a lot of credibility to Fed Jerome Powell these days. You're also going to have a bunch of other Fed speakers tomorrow, and then same story on Thursday. You get Fed Jerome Powell again and more Fed speakers. You're also going to get on Thursday existing home sales month over month and existing home sales year over year, as well as continuing jobless claims and initial jobless claims. Initial jobless claims last week came in hotter than expectations. You're expecting more increases to initial jobless claims as well for this upcoming week, hitting as high as 271,000. So forward indications such as the initial jobless claims look like the labor market is starting to weaken by quite a bit. So keep that on your radar, at least for Thursday. Fed Jerome Powell tomorrow is going to be big, as well as, like we said in the last video, FedEx earnings today and after hours also will be big for our markets. Now, what Morgan Stanley has to say is interesting. They say the stock rally is facing a bearish cocktail as falling inflation eats into profits and the Fed saps $1.2 trillion in liquidity out of the market. Now, you might find this interesting or confusing, but inflation eats into profits. That falling inflation eats into profits. That's because when inflation is high, companies raise prices. A lot of companies did not see their direct costs improve by much or go higher by much. But virtually everyone was raising prices for everything because inflation was high. Well, they're able to do that. Well, when inflation falls, they're not able to raise prices as much. So the margins start to get compressed and the earnings start to not look so good, right? And that's the argument that Morgan Stanley is making. They also see $1.2 trillion getting pulled out of this market by the government, essentially, the Treasury, filling their TGA account. You're going to have a $70 billion bond auction this week alone for 1 month bonds. right? Now, Morgan Stanley says, quote, investor sentiment and positioning has turned 180 degrees at an inopportune time in our view, strategists said in a note on Tuesday, pointing to the growing optimism for stocks as the S&P 500 extends its strong performance this year. The benchmark index is now up 20% from its low in October 2022 and officially entered a new bull market in early June. But that uptrend could soon face challenges, the bank said, particularly as inflation continues to ease. Lower inflation is desired by consumers, but it's a potential headwind for corporations since falling prices can eat into revenue growth and hurt corporate earnings. Morgan Stanley strategists have sounded the alarm for months of a coming corporate earnings recession, which could potentially take profits down another 16%. Those losses could collide with other pressures that could weigh on stocks, particularly as politicians mull heavy government spending cuts and Fed continues to reduce the size of its balance sheet, which could further tighten financial conditions. Government spending cuts could notch $1.5 trillion over the next decade, according to estimates from the Congressional Budget Office, a move that is expected to weigh GDP down 2% over the next year. Meanwhile, the Fed is expected to sap $1.2 trillion over the next 6 months out of the market by issuing treasuries, which could be a major headwind for stocks. Quote, this should begin to hit asset prices by the end of this month and carry into the fall. In addition to this domestic dynamic, we think global M2 in US dollars growth is also likely to flatten out and possibly fall again, adding one more element to the cocktail that could surprise newly minted bulls. Wall Street experts have been divided on the current rally in stocks, with some commentators warning of a sharp pullback in the U.S. still faces an elevated risk of recession. The economy has a 71% chance of tipping into a downturn by May 2024, according to the New York Fed's recession probability indicator. That has actually been increasing. So I think Morgan Stanley has some good points here, right? I don't think they're wrong by any means necessary. And that potential headwind for our markets could be a headwind for hedge funds and institutions as well, which could dry liquidity a little bit faster than what people expect. And that could end up being a positive to trying to squeeze shorts out of short positions. Now, if we take a look at AMC stock here on the day, as far as the option activity, 3% positive order value. It's been another big day for the Bears. Another big day for the Bears loading up. You have seen 23 orders totaling $4.17 million today. A lot of those are deep in the money puts, and those help drive down the price of AMC as market makers have to go out and short more shares. More and more shares every day needing to be sold short by the market makers just because the option flows have been so negative. Now, if we take a look at some of the other factors of a short squeeze, those actually look quite encouraging, like the cost to borrow fees, which are spiking, as well as the days to cover, currently sitting at 8.69. That is up 61% in the last 3 months. That means today you are more squeezable with AMC than you have been really ever. That's why the short score of AMC is at 94 out of a potential of 100. You look pretty dang squeezy. Okay. Now, in the last 3 months, the short dollar amount is actually positive as well by about 8.3%. The current dollar amount sold short in AMC stock is sitting at $573.51 million. And over the last 3 months, the share price has actually fallen with AMC. So this means there's a lot more actual short positions in AMC than what we've seen over the past couple of months. That means if AMC does rally at the end of this month, due to that effect of, like I said, sell the rumor, buy the news, that could turn into a colossal short squeeze for AMC very quickly. Okay, you're still sitting at 100% share utilization. Cost to borrow fees are spiking yet again today at 227.5% for the cost to borrow average. Cost to borrow max 269%. Cost to borrow minimum at 135%. With very few shares really able to be lent out. The availability of shares right now is super low, and that's a reason why the cost to borrow rates continue to spike higher. There's only about 7,000 shares that are currently available to be lent out. That's a big problem when AMC does start to actually rally, in which, again, I think after June, really in July, that's where AMC starts to rally, because at that point, AMC is going to be able to raise a lot more capital if the courts let this reverse split go through and ultimately dilution. AMC is going to raise a lot of capital. Short sellers are not going to have a short thesis left because AMC's bankruptcy probabilities are going to be gone. That is why I am bullish currently on AMC stock. But there are headwinds in the near term for the markets, such as FedEx earnings today and after hours, as well as Fed Jerome Powell on Wednesday and on Thursday. So expect some more downside from here. Don't be surprised when that happens. By all means, it's going to happen. Or at the very minimum, you're going to trade sideways for a while here. So that is going to do it in this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.